Hey everybody, and welcome back to Am I Catching a Falling Knife? I'm your host, Dave, and on this show, we dive into stocks that are seeing some significant drops, trying to figure out if it's a true opportunity or if we're just going to get cut. Today, we're taking a close look at a name almost everyone knows, PayPal, ticker PYPL. This digital payment giant has had a significant drop in the last few days, and that certainly puts it squarely in our sights as a potential falling knife. So, let's pull back the curtain and see what's really going on. The single most dominant narrative driving this price action, despite some genuinely good news from the company, is the intensifying competition in digital payments and growing concerns about slowing user engagement. What's fascinating here is that this market anxiety is actually overshadowing some really strong Q2 2025 financial results and even raised full-year guidance. It's a classic case of the market focusing on future headwinds rather than current performance. So, what exactly is PayPal? Well, it's a leading technology platform that makes digital and mobile payments happen for millions of consumers and merchants globally. Think about it. Every time you use PayPal, Venmo, or even some of those behind-the-scenes payment processors like Braintree, you're interacting with PYPL's ecosystem. Their revenue primarily comes from transaction fees, which make up over 90% of their business, with the rest from other value-added services like currency conversion or instant transfers. Financially, they're a giant with $31.8 billion in annual revenue, a healthy $6.0 billion in free cash flow, and a gross margin of just over 41%. But here's where the narrative bites. How did these competitive pressures and engagement concerns translate into an impact on earnings? Let's break down the math because this is where it gets interesting. The market narrative points to intensifying competition and slowing user engagement. Now, knowing that PayPal's transaction revenue segment makes up a whopping 90.71% of their total revenue, any pressure here is a big deal. We're estimating that these combined pressures could create a 4.0% headwind on that core segment. If you do the quick multiplication, that's 90.71% multiplied by a negative 4.0%, which translates to a negative 3.63% impact on PayPal's total revenue. Then there's the other value-added segment, about 9.29% of revenue. While not as directly exposed, overall slowing engagement can certainly have a spillover effect. So, we're putting a modest 1.0% headwind on that segment, which works out to a negative 0.09% impact on total revenue. Add those up, and you're looking at a total estimated revenue headwind of about 3.72%. Now, converting a revenue headwind into an earnings impact isn't always a one-for-one. PayPal has a solid gross margin of 41.24%, and with operating leverage from relatively fixed expenses, a revenue hit usually translates to a larger percentage hit on net income. The narrative explicitly says these concerns are overshadowing otherwise strong earnings beats. This suggests that while PayPal's underlying numbers might be good, the market is discounting their sustainability or future growth. Our estimate is that this overshadowing effect translates to upcoming quarterly earnings being about 6% lower than they would have been had these competitive and engagement worries not been so prominent in investors' minds. So, how do we figure out what this stock is really worth with all this noise? To figure out what this stock is really worth, I'm looking at it from two angles using data I pulled from finviz.com. First, a discounted cash flow or DCF model. This is a classic valuation method that tries to project future cash flows and then discounts them back to today's value. For PayPal, with assumptions like a projected earnings growth rate of 12.1%, a discount rate of 9.5%, which is essentially our required rate of return, and a terminal growth rate of 2.5%, what we expect the company to grow at indefinitely after the forecast period, our base case DCF value came out to around $102.04 per share. However, when we apply the impact of that market narrative, that 6% earnings headwind we just talked about, the narrative-adjusted DCF value drops to a more conservative 92.35. That's the market literally pricing in its concerns. The second method is a bit simpler, a PEG-based valuation. PEG stands for price earnings to growth, and it's a quick way to see if a stock's PE ratio is reasonable relative to its expected earnings growth. A PEG-based fair value for PYPL comes in at approximately 84.90. This method often gives a more conservative quick-look valuation, and in this case it's lower than our DCF, suggesting that even with growth, the current earnings might still be a bit stretched given the competitive landscape. Given all of this, and looking at where the stock is trading around 69.71 today, those valuation ranges of 84 to 92 offer some interesting insights. But remember, as a falling knife hunter, I'm looking for clear support. So, if PYPL continues its slide, the levels I'd be looking at for potential entry points are $50, $45, and even $40. These are the zones where the risk-reward could really start to tilt in our favor, assuming the underlying business remains strong. So, that's a wrap for PayPal. As always, folks, remember, this is not financial advice. This is just one host's take on the data. You absolutely must do your own research, understand your own risk tolerance, and make your own informed investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.